And happy Thursday, everybody. Welcome back, Market Rebels, and everybody on our YouTube and Twitter channels. Well, no surprises here. More volatility in the markets. We had probably the big news this morning. We had the CPI came in at 9.1%, much higher than the 8.8% expected. That was for June. And then we had the jobless claims for the week ending July 9th. That came in 9,000, an increase of 9,000 to 244,000. So that kind of spooked the market a little bit, sent the Dow futures down about 300 points before the opening bell. And I just checked, I didn't see the actual close, but the SPY was down about 0.25%, and a pretty good sized green candle going into the close. So it looks like we're starting to rally out of it. So again, things that you just would never expect are happening. Of course, we're going into earnings season. So all of this spells potential future volatility. And this is why you need to keep your trading tune-ups. It's always about understanding how to make better decisions and understanding the tools that we do that with. And that's what we're here to do. We do it every Monday, Thursday, Friday, 4 p.m. Eastern Time. Now, if you've been following us for the past couple of weeks, we've done kind of a new little topic here of pricing boundaries. And these are little theoretical boundaries, kind of like little fenced-in areas where option prices have to reside. They have to obey these ranges. Now, if you want to get really technical and zoom in on them, you need a pricing model, but it really helps as a trader to understand these general boundaries. So last Friday, we talked about our first pricing principle. Today, we're talking about pricing principle number 2. Now, again, there's a lot of these different pricing principles, and I will be sharing these in the near future. But for right now, these are two of my favorite. I think they're two of the strongest that every trader should know. It's been my experience. Most people see this and go, never seen this before. And then tomorrow, on Friday, we're going to look at one application of this. And then that's what we'll look at next week as well, how we can use these pricing principles. So for today, let's take a look at, let's move this out of the way here. Our second pricing principle. Let's just call it pricing principle number 2. Let's call it the difference in strikes. Now, as a recap, the one that we talked about Friday said that lower strike calls and higher strike puts have to be worth more money. That's assuming we have the same underlying stock and the same expiration date. So this is a related one. So we're just going to talk about now the relationship between strikes. So to kick things off, I want to just show you the basic principle behind this second pricing principle here. So I want you to imagine that we have two envelopes with some cash. Of course, they're hidden. We don't know how much is in there. Blue one's got some cash, but one thing that we do know, whatever amount is in the blue one, the red one contains $5 more. So now think about this. If you, as the market, prices this blue one based on a certain number of thoughts and feelings, and here's what we think it's worth, what is the most that the red envelope could ever trade for? Maximum of $5. Because we know that's the only additional benefit you're going to get from that. So that seems like it's pretty obvious. And that's really all that's happening here with this second pricing principle. So kind of keep that in mind. So what does this one say? Well, what it says is that for any two calls or any two puts, what that means is that they both are calls or both are puts, not one of each. The difference in their prices cannot be greater than the difference in strikes. Now, it's important that you understand it's the difference in prices that cannot be greater. A lot of times traders will get this reversed, and they'll say the difference in strikes cannot be greater, which is definitely false. In fact, most of the time, the difference in strikes will be greater, as you're about to see. So make sure you get the definition right. It's the difference in prices cannot exceed the difference in strikes. So for instance, let's say that we have a $100 call. We look at our broker's platform. It's trading for 10 bucks. What do we know about the 105 call? Well, because of this pricing principle, we know that it has to trade for a minimum of $5. Otherwise, there would be more than a $5 difference between them. So even right off the bat, you can see where this can play an invaluable role for your rolls, for your diagonal spreads, your vertical spreads. It comes into play a lot. So right there, without even looking at a pricing model, I know that the 105 call has to trade for at least 5. So what are we looking at here? We've got the $100 call gives us the right to pay 100, and the 105 call gives us the right to pay 105. So think about it. The $100 call says you can pay 100. It's the same stock, same expiration date. Everything is the same. But the 105 call just says you got to kick in an extra $5. That's it. That's the only difference. Or conversely, we could say that the $100 call does exactly the same thing as the 105. It just gives you a $5 discount. And so the most it could ever trade for is $5. Think right back to the envelopes. So once the market prices the 105, we automatically know a range for the 100 or vice versa. However, if the difference is greater than $5, what do you suppose happens? You got it, arbitrage, which is what we talked about last week. So for those of you who missed it, quick recap. Arbitrage is a series of trades that result in a guaranteed profit, but there's a second condition that there can be no cash outlay. And the second condition is necessary because if we just said it's a guaranteed profit, that's not really correct. You could just go out and buy a T-bill, say, hey, I've got a guaranteed profit, and therefore I'm an arbitrager. Not true. And yet a lot of times this is the definition that a lot of traders will say, oh, it's a series of trades that results in a guaranteed profit. And that's not, it's really a little short-sighted. We cannot use any of our own money. It's a self-financing type of a strategy. Now, again, people usually think that arbitrage should be illegal, that these are the vultures of the trading world, and that's not true. Arbitrage provides a very important economic function in that it keeps prices in line. It keeps prices fair for the rest of us. And so this is why we know that these pricing principles must hold. So let's see how this would occur. Let's say we've got our $100 call trading for 10. We've got the 105 call trading for 4. Now, what we talked about on Friday, lower strike calls have to be worth more money, and it is. 10 is bigger than 4. But by understanding the second pricing principle, we're saying, there's another boundary that's been violated here, and it's the difference in strikes. So hopefully this is going to help you to start seeing the quote board in a different light. Remember, I've talked about this in the past few weeks, that when you look at these quotes at your options chain, there's a very logical progression and mathematical reasons for these prices, and you should be able to look at them and see what's going on. So if we were to see this on the board, we know that we have a $5 difference in strikes, difference between 100 and 105, but we've got a $6 difference in prices. And what did the pricing principle say? The difference in prices cannot be greater than the difference in strikes, but here it is. Now, again, in the real world, don't expect this to happen, and especially to this degree. I'm doing it just to make the point why you would never see this. So let's just assume that it did occur. What's going to happen? Well, arbitrageurs or computerized programs these days will sell the $100 call, trading for 10. They put $10 in their pocket, and from that 10, they buy the 105 call for 4. So notice that, again, it's self-financing. They didn't need to use their own money. What's the net credit here? $6, just collected 10, spent 4, but they have a $5 liability. This is where it's important from Friday's class. You are selling the more valuable strike. You have the obligation to sell shares for 100, and you've got the right to buy them for 105. So think about it. If you sell shares for 100 and you buy them back for 105, that's a $5 loss. There's no asset in this equation. It is strictly a potential loss. It's a liability. But you're getting paid $6 for it. Not a bad gig. So think about this. What if I paid you $6 to take a $5 bill out of your wallet and tear it up? How long would you do it? Sit there all day and do it, right? That's really what's happening here. You're saying I'm subjecting myself to a $5 liability, but if you're going to pay me $6 for it, I can't lose. And so here's what this risk graph would look like if we did this trade, selling the 100 and buying the 105. We'd look like this. It's a bear spread. It's a credit spread. And down here, you can see our guaranteed buck. There's our zero line, the black line. Now, we might actually make 6 if both options expired worthless, right? Because we collected the $5. I'm sorry, we could make $5 in the difference plus the dollar that we got paid. So we could actually make a total of 6. So not a bad deal. There's no reason to not do this. So what's going to happen? Well, arbitrageurs or computerized programs are going to jump on this. They're going to sell the $100 call, put downward pressure on its price. They're going to buy the 105 call, and they're going to put upward pressure on its price. And what happens? Eventually, this is going to continue until the difference in these prices is less than the difference in strikes. Until then, it's a free ATM machine. You know, I'm paying you $6 to tear up a 5. We'll sit here all day long and do this. But as people start taking advantage of it, eventually it gets turned off, this free money machine. And that's how we know for sure this principle has to hold. You're never going to see it violated in the markets, and that's an important thing to understand. So here's our risk graph. You're going to move from the blue, which was our arbitrage, and we're going to get shifted down to where we do have some portion of the risk graph below zero. And once that happens, can't really say if it's a good deal or a bad deal or just a fair deal without further analysis. But we do know it's not an arbitrage. And now at this point, it gets shut off. But what happens here on the red curve? The $100 calls price is greater than the 105s. And that's how we know this is going to happen. So let's take a look at it from another perspective. If you have the 105 call, if you bought it, you can capture, think of it like a casting net. You can catch all of the prices above 105. Isn't that what a 105 call does? Well, if you have the $100 call, what's the most it can capture? It can just capture another 5. That's it. And so there's no reason in the world to say if they're pricing one option at a certain price, that the $100 call has to be infinitely more valuable. It's not. It's $5. That's it. It's also going to help you to understand how your different spreads are going to unfold over time. This is going to be the limit. All right, so hopefully that's a good way to understand what's happening. All right, so that's what the calls. What about puts? It's really the same idea, but let's go ahead and step through them. Let's say we see the $100 put trading for 4 and the 105 put trading for 10. Based on what we talked about Friday, higher strike puts have to be more expensive. Remember, that was Friday's pricing principle. Lower strike calls and higher strike puts have to be worth more money. So it is worth more money. It's worth 10 compared to 4, but now pricing principle number 2 steps in and says, nope, you still have a mistake here because you have $5 of a difference in strikes, but you have a $6 difference in price. In these prices, this is too much. So what would happen? Well, people are going to sell the relatively overvalued one, and they will buy the relatively cheap one. So they're going to put $10 in their pocket. From the $10, they spend 4, get a net credit of 6. And yes, they have a $5 liability, but who cares? We got paid $6 to accept it. So if both options go out worthless, yes, we can end up with 6, but worst case is we pay out 5 and we keep the buck. And so here's our risk graph. It's a credit spread with puts. It's now going to have a bullish bias. There's our guaranteed dollar. The zero line here is in black, so we cannot fall below 0. Maximum gain of 6. And again, this occurs if both options expire worthless. We keep the $6 credit. And that will happen if the stock is 105 or above. Both puts expire worthless. So that's what it looks like. Pretty cool deal. So what would happen in the markets? The 105 put, the arbitrageurs, computerized programs, are going to swoop in, sell the 105 put. They're going to swoop in and buy simultaneously, buy the 100 put. And what that's going to do is to start shrinking that spread. All right, so once again, this continues until the difference in prices is less than the difference in strikes. That's what you have to keep repeating. That will be super important for when we get to future classes. So there's our risk graph. We're going to move from the blue to something like the red. And once part of the risk graph gets shifted below the black line, no longer an arbitrage. If the entire graph were shifted below, it would be an arbitrage, or if the entire graph is shifted above. It's just a question of whether you're going to buy it or sell it. But when you're straddling it, you've got some below and some above. Now we really can't say. We'd have to look into different areas to try to figure out if that's a good deal or not. All right, so here's our second look at it with puts. If you have the $100 put, you can capture all stock prices in the downward direction, at least down to a stock price of 0. But if you have the 105 put, you can pick up another $5. So what do we know? We know that the 105 put can only trade for a maximum of $5 more than the 100. Now, again, that's important to understand. It's a maximum. Don't think that it's always $5 more because it depends on where the stock is and how far we are till expiration. So here's how we can kind of get some ideas. So let's look at some reference points. These are just call options, but it would work the same with puts. Let's say that if the stock is at 100 here in green, anything that's an at the money spread or near the money, you're going to roughly pay $2.50 to make $2.50. Basically a coin flip. If it's deep in the money, in this case, out of the money, let's say, remember the stock's at 100, these are maybe the 125, 130 strikes and so on. They're going to be cheap. So you might be able to buy the 125, 130 spread for 50 cents or 10 cents. Why? Not much of a chance for it to go in the money. People bid the price down, pushes the reward up. But those are going to get, the difference in those strikes is going to do what? Get very, very small. Now, if we go deep in the money, over here to the left, what happens? Now we're going to start approaching 5. And in fact, if I made the graph bigger and we could go further left, they would eventually hit exactly 5, but not 501, not 510, 5 would be the maximum. All right, so that's the theory behind it. Let's go take a look at it. Here's some Microsoft quotes. Let's take a look at some deep in the money ones. Now notice the stock is, let's call it about 265. Let's pick some strikes. Here is the 160, 165 spread. I'm going to use the mark. If we buy this, look at that, 475, kind of what we would expect. What if we looked at something a little closer? It's still in the money. This is the 210, 215, right, with the stock at 265. So it shouldn't be 475. It should be a little cheaper, and there it is, 463. This is more guaranteed, relatively speaking, than this one. So the market's going to discount this a little bit. What if we split them up by 10 points? We've got the 190 and the 200. What's the difference in these prices? $9.80, exactly what we would expect. Not 10, or not 10.01, not 10.50, 10 maximum. So what do we know is going to happen to this spread as time passes or as the stock continues higher? It will hit a level of 10 and never move. All right, and that's the pricing principles in action. Let's take a look at the at the monies and out of the monies. Let's buy the 265, the at the money, and sell the 270. Well, what did we say before the reference points? Should be about 250. There it is, 252. Like I told you, when you start to look at the quote board, these will be very obvious to you. And this is where you're going to see a lot of opportunities. What if we do this? What if we look at the 272.5 and the 277.5? That's still a 5-point spread. It's out of the money, not grossly out of the money, but remember the stock's at 265. So this should be less than 5. And there it is, $1.68. Now, of course, whether it's $1.68 or $2.50 or $3 is up to the market to decide, but we know it's got to be cheaper. And we know the worst it could be is at 0. But we also know the maximum it could be as 5. All right, so these are some of the pricing principles in action. But the, let's take, we have one more here. Let's look at the 260, 270. Here's a $10 spread, roughly at the money. Should be what? Coin flip. Should be roughly pay 5 to make 5, and there it is, 565. It will at least give you a pretty good idea of where we are. And so that's the pricing principle in action. So the thing to remember is that for any 2 calls or any 2 puts, the difference in their prices can't exceed the difference in strikes. And if you remember that, I will promise you it will come back in spades in the future. It's going to explain so many things you had questions on about, especially with spreads and how they behave and when we should roll them and why we should roll them, all things we'll look at in the future. But for now, if you didn't see these pricing relationships, if there are things that are new to you, this is just the best proof that you definitely could benefit from education and a coach. And here's one of the best things you can do for free. All right, so call 815-957-9125. The Market Rebellion here, our wonderful coaches here, super experienced, some of them with decades of floor trading experience, market making experience, can have a chat with you for free. I mean, why not? All right, so give them a call, tell them what type of trading you're doing or what you're trying to learn, and you will be amazed at the insights you will gain from having somebody in your corner who can do that hand-holding and help you through the trades. But that's part of what we try to do here with the trading tune-up. So if these are helpful to you, please join us Monday, Thursday, Friday, 4 p.m. Eastern. Now, tomorrow we're going to look at pricing principle 1 and 2, and I'm going to show you a neat way to put them to use, a practical use. And we're going to look at that next week as well. So please give them a call. And I hope that helped. And that's what we're going to do here at Trading Tune-Up. And so please continue to join us. We'd love to have you. And we'll see you tomorrow.